Hello, good afternoon. Welcome to the last webinar of the Invest Horizon project. The webinar today will be focused on alternative finance for startups. Next slide, please. As you all know, Invest Horizon is a project financed and promoted by the European Commission in association with Eureka. The lead partner is Tectur, and EVN is also a partner of the project together with BPI France, Meta Group, BBCom, Jura, and IS. Invest Horizon was launched in 2019, and it has supported more than 500 companies to boost their investment readiness and investors' relation through between 4 and 6 months for an acceleration program. As you all know, the focus of the webinar today will be alternative finance for startups. And for this webinar, we have an excellent speaker. The speaker today will be Mark Rayner. Rayner is a coach, mentor, business builder, and access to finance specialist at St. John's Innovation Centre in the UK. He has wide experience in high growth technology business, and he founded successful corporate finance and venture capital funds in Europe. I don't want to take more time of Mark's presentation, so I will give him the floor. Before, just to let you know that if you have any question or doubt with regard to the project, you can contact my colleague Livia, who's in the screen now, and myself through the email addresses you can see on the screen or on the screen on the presentation you will receive after this webinar. Mark, thank you very much for your time.
Well, thank you, Ruben, and it's good to meet everybody today, even though it is virtually. But I've got the pleasure to actually host the alternative finance slides, which we'll bring up now. I'm going to go through these slides, and if you can think as we go through the slides how that may be relevant for your company or your startup, and then we do a Q&A session after the final slide is gone. So we'll just start on the slides, if you just bear with me. Right, alternative finance is a really important thing that we forget about when we're entrepreneurs. We're always looking for the big picture, the venture capital, the private equity player, and they're pretty rare. And I always like to think about alternative financing is actually looking for money where the zebra are, and it's a really good analogy. So Ruben has told you all about me. One thing I will say is that I've got about 25 years of experience of raising money and actually spending money on behalf of a venture capital company, and also in high growth businesses. And I've had 4 of my own businesses over this period. They've always been international, and I've always sourced my money in different ways. And I hope today we'll be able to understand a little bit more about how you can go ahead and do this. So there are 4 sources of alternative finance in general. They're grants, debt finance, sales, and different type of investments. So grants. Grants are quite, not easy to get, but they're quite good to get, because from a funder's perspective, the local or national organisation, the funder will accept a high risk of the money coming into you and not see anything at all, because it's fully funded as part. It's a zero cost to the company. That means that you don't have to account for it in an investment type way or a debt type way. And having that grant can create a credibility for when you do financially go and have a look for money and investors. And it also can act as a leverage point for you. And that leverage point is really, really important. In the UK, it's Innovate UK, KTN. And when investors see that, they see that it's been a badge of a company going through a program that validates half of what they're trying to do. Now, what are the downsides to grants? They're difficult to locate. I'm saying they're difficult to locate. You can find them, but when you apply for these, the pass rate is so high that probably 90% of applications won't make it through to that grant stage. They're match funding usually. They can be anything from 30% to 70% on average. You do rarely get the 100% grants, but again, grants can be really distracting. They're distracting because there's a lot of paperwork involved. There's a lot of time that you put in. You may have to get specialist advice to help you to fill out your grants. And really, you fill it out today, you may know in 4 months or 6 months' time whether you've got the grant or not. Your companies don't stand still on day one that you fill that form out. Your companies are trying to get to profitability and to become successful without waiting for the outcome. And a lot of companies that use the grant system or try to use the grant system end up taking their eye off the ball and having a look at private finance, and they tend to wait until the end and then go, oh, we didn't get the grant, the company's not viable. Remember, a grant is a supplementary piece of financial instrument for you. You also have to look at the regional, national, European, and the sector-specific areas. In the regions, the growth hubs themselves will help you to actually go for grants, go for matched funding, and they will have specific requests for taking their money and spending it on you. From a national level, we in the UK have Innovate UK. In different countries throughout Europe, there will be your national program that will actually be able to give you those programs that you can go into. And one of those is grant funding, yes, again, but it could also be some debt or loan funding from the local authority or from the banks. We have Europe, we have the Horizon Europe and the EIC Accelerator. And then we have sectors. We're seeing a lot of money coming from the sectors. In medtech, it tends to be from charities. It could be from Parkinson's disease charity, Cancer UK. It will be from those types of organisations that see a point in actually investing members' money to help to make people's lives better. And we've also seen it from other organisations, sometimes corporate. They don't want to invest, but they like to put a grant out or an access a loan out to these companies. So there's lots of things that you can see that are non-governmental, but you have to look for them, and you have to have a good case of why you and why they should actually invest their grant money back into your business to give it a good kickstart. The next part is debt financing. I primarily say to anybody looking for venture fund or private equity to look at this route and look at it very, 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 very clearly. Why would I want to do debt funding? Because if I can debt fund, I don't have to give any of my company away. If I can debt fund, it means that I can actually have a longer term debt financing program for my company, and I can grow. And I can grow faster, but probably not as fast as VC and private equity money allows me to grow. it can be very flexible. And I tend to talk to debt agents to think of one thing. That one thing is to say, today we're putting money into this high risk business. In 2 years' time, that's helped me with my revenues, and therefore the debt should be cheaper. And lots of companies take on debt early and forget to go back and renegotiate the debt that they want in the business. So the interest rates you can actually start to manage as you become more profitable. Why is it a difficult one? It's faceless. And when I talk about faceless, it's an accountant writing a financial forecast for you. It's that forecast going to a debt funder. That debt funder looking at the fundamentals and signing it off and sending it to the credit committee. The credit committee is so far removed from you that they're looking at numbers only, yields and returns and risk. And so you have not much of a say once you've done your numbers and you've got your forecasts about whether they will accept you or whether you're outside of the parameters of what they can lend into. Here's another one for you. Although they're good and they're flexible, you have to consider one thing. And those loans can be called in at any time. And we're seeing that today in the marketplace. And you may well have a 4 or 5 year program, a debt program, and after a year it may be called in. And that's because primarily every quarter, every 3 months, you're actually sending information, financial information to the debt providers. And if they feel that you're too much of a high risk and that you're not keeping to plan, they will ask for their money to be returned, or you go and get a new debt facility from someone else. But that's where it becomes quite difficult. Treat it very, very safely. And interest rates. Everybody here knows that the interest rates are not yielding very much in your interest accounts or in your current accounts at your bank. For an early stage company, interest on the money that is actually given to you can be between 15 and 25%. As you progress, it goes down. And typically, a medium-sized business that's doing quite well, that's probably got a turnover between 2 and 5 million and can afford the debt repayments, they're looking at somewhere in the region of about 6 to 8% on interest. If you do get it lower, it's because someone else is actually doing something and they're not that bothered about making money. But there's a program right at the end of this call that I will actually explain to you how debt becomes cheaper by people who have an idea of what they want out of their relationship with you. So debt finance, how much is there out there? For early stage companies, very, very little. And it's going to be country specific. So in the UK, you tend not to find very many companies that will go into what they call venture debt, pre-revenue, early revenue companies. In other countries, you may well find that you've got a Sparkassen Landesbank in Germany who will have a provision to be able to help those companies a little bit more. So really, it's about going to your specific region and asking whether is there an alternative to venture capital? And if there is debt, what type of debt and who actually issues that to you? There are startup loans. They tend to be very, very small, sub 25,000 euros. That's to help you to kind of get yourself ready. But again, that's a process, it's very, very few and far between. We see innovation loans. And so in the UK, again, I go back to here because Innovate UK, they have a grant system and they have a loan system. That's not to say that a company without revenues or any predictable revenues within the next 12 months are eligible. They're quite unlikely to be eligible. So you need to find an organization within your own networks that will take on innovation and innovation loans. In the mid-2000s, and it's coming back into effect, there is venture debt. There is not much of it around, and it's more kind of UK, US, and it's predicated on you signing over your IP as security. But that's a very, very specialist debt. Now I'm going to talk about specialist loan companies, and I put them outside of regulation. There are companies outside of financial regulations who do lend money to companies. Now, you have to be careful if you're outside of a regulated environment, but companies are set up by individuals that are wealthy or teams of people that have money, and they invest directly into entrepreneurs, and they will tend to put debt into the business. If they're investing off of their own balance sheets and their own bank account, it's unlikely that they're regulated. And so you have less protection if things go wrong. If they ask for their money, they give you money on a Friday and ask for the money 3 weeks later, it's a commercial deal, and you will actually be going through the courts for them to try and get their money back. Beware that you have got less energy and less resources to be able to have any ombudsman to help you with that financial instrument. Lastly here is debt crowdfunding. It's a good option. It is an option. We see peer-to-peer lending. We see crowdfunding. I'm going to go on to crowdfunding, so I'm going to leave that one there, but I would say again, that's usually an unregulated event and has its good sides and its bad sides, and we'll go into that. Do not underestimate this. This is a source of finance that people forget. I have, in this presentation, a case study, and you'll be surprised how much money you can actually get when you do sales right. Because you can go everything from selling something and getting a prepayment for the sale, sell and cash on delivery, or cash within 7 days. Just think, all those sales that you could get. What you have to do on that type of sale is cover your sales, i.e. your cost of sale. So if something costs you 30 euros, you sell it for 100 euros. In order to cover your sales, you need 30 euros upfront. That way you can still ensure that your business actually runs, and you can still buy goods, sell goods at cost with an upside of 70 euros that can be collected later. Now, having sales, you can also use invoice discounting. So what they call factoring. You can actually take your invoices that you put together and you can get up to 80% of the invoice value. It's relevant when you've probably got a business of about 100,000 euros worth of turnover, because before then it becomes much, much more difficult, and the lending criteria for the lenders tends to go down, so they'll probably give you 60% of the invoice value. And you've got to be sending those invoices to people that they can credit justify. So just be careful about that. I say reinvest profits into products and services. How many of you can actually think to yourself you want to grow from 50,000 euros to 5 million euros, and you want to do it in 12 months? The likelihood, unless you get cash up front or cash on delivery, it's extremely difficult to actually operate and get to that scale within that 12 months because you just don't have cash flows. And let's face it, investment's not about kind of getting better cash flows, it's about getting better market share. And all you should be worried about today is how do I make cash flows work for me and not profitability. I come from the old school of saying that I've seen many companies that are profitable, but they're insolvent because profitability isn't a sign of financial well-being. It's a sign that you've got invoices outstanding and you've not got your money for the sales that you've made. If your bank balance is good and you're profitable, it means you're looking after your cash flow position. Doing sales keeps you in full control. The downside to that is that probably your sales itself, you're going to have to reset your objectives, not to be the 5 million pound company in 12 months time, but maybe £1.5 million company in 12 months time, and accelerate slower. And you know, we all know that sales takes time, and the more complex and complicated the sale is, the more difficult it is to actually kind of fund that at a very early stage. So for people with big corporate, large hardware, you know, supply problems, you're still going to have those problems. But there are help, there's help out there for you for when you do your trade finance. But again, most companies that are offering that service are looking at you today. And if you're too small, they'll wait until next year to give you some time and to get you into their programs. Wow, crowdfunding, my favorite. So there's four clear types. There's debt, equity, reward, and donation. I must admit that the issue for me is debt. It's really peer-to-peer lending, and it's quite a complex way that the company has to do it. The company has to go to a specialist crowdfunder for debt, and they are likely to be regulated because they're swapping financial instruments. It's not much different to traditional finance and debt finance. I bet you anything you like it's going to cost you more money because it's not about 15 or 16%, but the broker that's looking after the crowd debt is probably charging you another 3 to 5% on top. And there's no government guarantee. You're borrowing money from people who want to be repaid with their interest and the capital that they put into the business in a certain time. It will be quite difficult to have significant changes in your debt profile. What I mean is the payment terms. And if you go to a larger and single debt provider, there is an ice cream shop full of different types of debt out there, from anything from interest only for 12 months to balloon payments at the end of the period and a straight repayment, an interest payment. We can go on. From an equity perspective, well, just think, it's not going to cost you much to get onto the platform. Typically, €2,000 doesn't seem much. And you need a pre-commitment of funds. Now, this is an interesting one. I went to try and crowdfund one day, and I needed €200,000. And the bigger problem that I had with €200,000 was that the crowdfunder asked me to send out emails into my own environment, i.e. to my connections on LinkedIn, my personal connections. And for me to raise around about 60% of the initial funding and make sure that I pre-marketed under their advice to get that 60%. So on day one, my friends and family loaded in, put the money into the crowdfund, and they literally could see that I was up at number 10 in the list of companies that week that were going to be brilliant. And then basically, hopefully, other people were going to put cash in to get me over my 100%. How many of you thought that you just give you 2,000 euros in and you get 80, 90% investors? And you don't have to do any of the work. It's a shock. It shocked me that I had to get between 60 and 80% on any platform, 60 and 80% of my own referrals. So why wasn't I picking up the telephone and calling all my referrals to say, I have a great company, invest in me? And on top of that, I did most of the work and I had to pay 6% of all the cash that came in, plus the 2,000. Okay, think about it. Reward. This is a good one. Anybody out there with products that you would like to sell tomorrow because you want to turn that into cash, go to a rewards program. A classic example for me, I was advising a lady in the cosmetics industry. She wanted to do crowdfunding, equity crowdfunding, but she just didn't have the connections. She had 250,000 euros worth of lipstick, and she didn't know what to do with it. And it was vegan lipstick and it was in trend. So we set on a plan. And she went to a funding platform for a reward. What we did is we managed to sell the £200,000 worth of lipstick and the back order of another 200,000 euros that she had to supply. No investors. The product had a shelf life of about 12 months left after being on the shelf for 18 months. And she walked away with a significant amount of cash to put back into her business. And now she's winning awards all over the world with her product. But it was the kickstart. What are you going to do with your product? Think about it. If you've got stuff that product in your drawers going off or being obsolete in 12 months' time, this is a serious way to actually kind of unleash your cash, other than giving away your stock. And you don't want to give away your stock. And the last part is donating. But I would find donating is quite a difficult program. It's inspired by people having a cause. And if you're selling washing machines or something that really is straightforward, there is no real cause. You may consider you're thinking of the cause, but it's not a cause. Very, very few companies get funded like this. And when they do, they tend not to get funded in a very big way. And let me be quite clear. It works. Crowdfunding really does work. But for how many people? This is it. 80% of campaigns, no matter what they are, in crowdfunding, fail. 40% don't even get off the ground. You fill out your form, you pay your 2,000 euros, they never go anywhere. So what's left? 11% of companies that apply for crowdfunding get 100% or more of their funding. 9% get 50% of their funding. And there's a criteria by some of the crowdfunders that unless you reach 75%, that crowdfunding fails and you can't collect. So think, crowdfunding 11%. Think how long it's going to take you to do that, whether your product is right and whether you're willing to take the risk. and go for it. If you want to do it, go for it, because that's the thing that you have thought about. But do not rush into any type of crowdfunding. Think about the outcomes. Debt, you've got an obligation. Equity, you've got loads of shareholders who probably want to ring you up at 3 o'clock at night to talk about their 10 euros that they invested in you and why aren't you doing something really cool. You've got the people who are on board saying, okay, fine, when's my package? Where's my package? You know, you said July, but it's now August. Where's my package? So think about all those kind of connotations. It's quite an interesting one. So straightforward, crowdfunding. The good bits, loads of platforms. Flexible, lots of options. I think too many. It can help you to identify your customer base. Remember the lady with the lipsticks? She now has a whole load more customers because one friend after another said, we need to buy vegan lipstick. Fantastic. You know, it can actually validate and add credibility for when you want to do further crowdfunding, or whether you want to go to an investor and say, look, you know, it was just the messaging wasn't right when we did it, but we went to a platform and we've proven that our technology and our company are fantastic. The bad bits, there are hundreds of platforms. Which one do you pick? And not all the platforms are that good. And they may offer something, it may be not cost effective for you, but you don't know. Look at the hidden costs. I think what you need to do is you need, from the crowdfunding side, how difficult it is for you to attract the next investment round. I was involved in venture capital when crowdfunding came along. It was probably 2 to 3 years inside of my VC career. The venture capitalists for 4 or 5 years were saying, we're not going to deal with any company that has a crowdfund in it because there's too many investors. And today, some of the crowdfunders are getting through that and over that hurdle by actually offering that the crowdfunder itself actually is the nominated account, i.e. it's the one shareholder for all of the people that have put money in. I still probably wouldn't look today if I got 100 or 1,000 investors in a company that has less than €1 million worth of revenue. It's just too difficult. You'd be at the shareholder meetings more than you will be at work. So I want to give you some takeaways. These takeaways are really, really important, and they're live cases. They're cases that I've been involved in. And how did these companies make money? Well, I've got the first company. You've got Autodesk there. Well, I got involved in a single-seat supercar company in the UK. 2 brothers. They could only make 2 cars a year. I had an order book of about 10 or 15 cars. Each car was worth about 100,000, 120,000 euros. And we were running out of money. We got some equity from the local authority to move to Liverpool. But our biggest partner in the next 3 years was Autodesk. So Autodesk are a global company with its headquarters based in San Francisco, who deal with 3D, CAD design and animation in the main. Multi-billion-dollar company. They weren't ever going to invest in this small company in Liverpool with 2 brothers, 2 cars being made and an order book of 10. But what they did do is they thought that the design was so pretty and so good and was using a competitor's technology for CAD. They decided to say, can we use your car to help us with our image. Long story short, 4 years later, they still hadn't invested in the company. They brought a car. They'd actually put in around about $1.5 million worth of advertising, which we didn't see the dollars, but we actually saw the advertising. They brought a whole new customer group to us. On that 4th year, we were making 100 cars a year with an average cost of 220,000 euros. And we were in 23 different countries. And we hadn't taken any investment in that 3-4 year period. It had actually been funded through getting customers through our relationships with Autodesk. So your product or your service will resonate with somebody who may not want to invest in you, but will give you the marketing dollars that you require in order to actually get your team to make money. And this was a fantastic example of an amazing opportunity. And I would say it was the first time I'd actually experienced a full-on global, taking us to Goodwood Festival of Speed for 3 years running, with a bill of around about £400,000. Marketing dollars of over $1 million, and untold connections that gave us an order book of about $10 million. Just think, that was money. And we cash flowed it, because what we did is we asked the customers for their money up front for each different part of the car we were bolting together. A non-dilutable debt opportunity using other people's money. The next is impact investing from family offices. So I deal with this. Family offices are looking not to invest in companies, but to take their technologies, create a company and a framework for family office and the company to work together in certain areas. And my clients in renewables. They saw the opportunity. So what happens is that the family office are investing in the idea. They're using their bank account to create a debt opportunity, which is 5 times the amount of equity that they're putting in their company, not in the company's company. The company is actually helping them with a certain problem, and together they'll be investing in a company together, and the startup didn't have to actually sell any shares, and now they're running off with around about 6 million euros to actually change the renewables energies market in Europe. And that's because they was an impact in investing, and the impact investor didn't, I call them an investor, I would call them an impact partner. They were amazing, and they're going places, and the family office know exactly what they want to do in the next iteration of the business plan. And because they're so well connected, they bring in other investors in, other debt in, and they can scale this business that I'm working with in a quick manner. So, venture capital and private equity. I found this picture which explains to me what I was. I was a goldfish in a bowl. I was unique in a bowl all by myself. I could make investment decisions all by myself. And you have to go and speak to loads of goldfish in different goldfish bowls all over Europe to find your money if you want to do venture capital and private equity. But the alternative finance market is an aquarium. It has big fish, has small fish, has nice fish, has not so nice fish. But what it does have, it has options. So think VC, private equity, 1%. The single goldfish in a single bowl, or 99% opportunity to find your finance in a different way. the aquarium model. So I hope that this has been of interest to you, and I'd love to take your questions, if I may.
Thanks a lot. Thank you very much, Mark. As usual, excellent presentation. We have some questions from the audience. Cyril Dusson wants to know, from all the options presented, what would be your best alternatives to venture capital for the therapeutic startup biotech? For example, with no revenue for another 4 or 5 years and need of significant capital?
That's a really good one. There are two types I probably would go for. First of all, I would look at venture debt. Typically, venture debt in the medical market is quite good. There will be grants and medtech grants around, so I would go for that. And don't leave the issue of going to a corporate and speaking to them, whether it be a CRO or pharma. And I think that that's quite an interesting way of looking for money. And there's no one way to look for money for medtech and pharma.
Excellent, thanks, Mark. And another question from Pascal Brunner: which crowdfunding platforms can you recommend? Which are the ones to keep fingers from?
That's a really good one. I can't give any advice on that. I wish I could. My guiding principle here is go and find out when the last deal was done. Go and have a look at how many deals they've done in your sector and the raise that they've done, and how many they've done in the last 12 months. If they haven't done any of those, or they're very rare, it's very rare you'll have the investors in that crowdfunding group that will actually help you.
Okay. Do you recommend using no-win, no-fee grant writers?
Yeah, bugbear of mine. Yes and no. I'm going to sit on the fence here. If you're going to pay a writer, they probably tell you that they get 100% of their things funded, or up to 85%, and it could be believable. I think you've got to look at each case. You've got to realise what the cost of the no-win, no-fee is, because it could be a higher cost than actually, having the initial fee. And one thing I find really interesting is that the grant writers make you write the grant, and then actually they review it. So the question for me is, how much value do they bring in? And if there was a 100-hour split, how many hours are they actually going to write for you and rejig, and how many hours are you going to write? And then really it's up to you as a company whether you want to pay and have a lower fee because you think success is going to be there, or with no fee. It's flipping a coin, unfortunately, because the percentage of getting your grant is so low.
Okay. And Jamila Alegría asks, for a specialty food company, what would be the ideal? Sorry, because now a new question appeared and I missed the previous one. For a specialty food company, what would be the ideal place to find investors?
Yeah, that's one of those interesting ones. It all depends how fast you want to grow, how specialty you are. I think crowdfunding is quite niche. Kind of having food for reward sometimes works. There was an amazing lady a few years back, actually was doing of all things kind of marshmallows that went crazy. She went crowdfunding and then found herself in Waitrose, John Lewis, Marks and Spencer's, and that's how she got on the trail. Most retailers don't want to pick up somebody who's brand new. They want you to have some traction and make sure that people will eat the food that you actually supply. So maybe crowdfunding is a good way of actually getting samples out there for people to start to spread the word about food.
Okay. And Alma Karabek, thank you for this presentation, Mark. And what about the possibilities for businesses taking at sustainability? Any special funds for the startups staking at sustainable development goals?
Yeah, there are. They're coming online now. They've only come online probably in the last year, if I'm honest. I think there's a way to go. I think the next 5 years is going to be really interesting. If I was a betting man, the places I'd be looking for investment would be carbon offset credit programs, where they have to get rid of money because the larger corporates are paying a carbon tax or a carbon offset. Here in the UK, we decide that planting trees is a winner. My view here is that actually picking innovation that's actually going to be sustainable is probably much more of a long-term runner. We're at the very, very early stages of seeing a new type of financial instrument for the carbon industry, which will actually help you with your sustainability.
Okay. New question from Anne Rudy. Having attracted an investor and secured interest in match funding from state agency, depending on external funding, but due to external delays, the investor pulled out. How can we keep interest from the state agency, and how quickly can we drive forward? And we'll be chasing other impact investors.
Yeah, that's a hard one. Yes, it'd be nice to find out, kind of why the investor pulled out, and whether you need that money because it's part of the state aid program, matched funding, and that's the difficult one. I probably would go to the state aid and just say, okay, how do you want to play this? We've got an investor lined up, or we have investors lined up. And really, it's about going out there again and finding your investors. So that's a tough one. And it may well be this, if they believe that you've got an opportunity to find the investor, that they will actually give you more time to find that one person or that collective that you need.
Excellent, Mark. Thank you. More questions being posted on the platform. Mark, thanks for the good overview. Have you some information about crypto crowdfunding? Asks Sergey Golovanov, sorry.
Yeah, I'm kind of crypto funding is quite difficult. I think it's really, really niche. I think that we've moved away from a crypto environment whereby it's what can we do is the theory. You're going to find it quite interesting to try and raise money on something that's a theory. If you've got traction already, then there are specialist investors out there, and go and have a look at the crypto exchanges. You've got Gibraltar, you've got Malta, you will actually find advisors out there that can actually help you, but you have to have traction. If you have no traction, that market has got a little bit mature. Okay.
Thinking, you talk about grants for startups, but actually I have struggled to find any grants that are willing to provide funding for a company with less than 2 years of trading and a cash flow of 100k pounds plus. Where can I get funded as a startup for initial setup and research and development costs?
You're likely to get that from I don't know what country the person's in, but here in the UK you'd probably go to the KTN. You probably might go to an incubator, bioincubator, like a biomedical catalyst, whatever you're in. It will be the smaller ones. In the UK we tie in what they call SBRI contracts, which are 100% funded up to £60,000. They're probably a good way of getting into the grant system. because sometimes when you're in an SBRI, you get to the next grant level. It is difficult. It's not impossible. And I see an awful lot of funded businesses going through grants that don't have any revenues, and they're early. They're just very good at writing.
Perfect, Mark. And one question from John Fagan. Where do you find family offices that look for carbon neutral, sustainable innovation funding?
Good one. By pure chance. If you have anybody in, really the family offices for me tended to have migrated to Switzerland. That's quite fertile ground for family offices. So really it's about finding somebody in the gatekeeper and understanding what their preference is on what they're investing in. And sometimes it's really good to just keep a view on the news. And you can find family office information. Notoriously, it's quite difficult to get in, but if you're hitting a certain criteria, they'll find you before you find them. And this is what this particular Swiss family did. They found the company before the company found them.
Excellent. And one question from my side, Mark. You mentioned different sources of alternative funding.
Yeah.
Any of them that you consider less complex in terms of the implementation, the administrative requirements, or more easy to put in practice?
I left some out that I would flag now. It all depends how much you want, and how much risk you're willing to take. Some of the funding and early funding, sometimes people just remortgage their houses or they sell their car. They find their credit card and they go on their credit card because that's the source of financing. That's probably easy. It's easier for the short term, but when you're looking for the bigger money, there's not many easy options. It's the type of business you're in, your sector. It's how much revenue have you got? And if you think of, I call it if you look at Europe, I'd say that Greece is hot, Norway is cold. Think of if you're really hot and you have no money and you're just burning and you're really, really hot. In order to get to Norway, you have to kind of envisage that you're going to have to be more stable, you're going to have to be more structured, and life becomes easier. It's just not easy when you're a startup to pick out any single one. I just do my homework. You've got the alternative finance opportunities. Go and have a look at them, see what figures out for you.
Excellent. I don't know if there's any other question from the audience. We're about to finish, and I don't see more questions on the platform. I think everything is very clear. Mark?
Good, thank you. It's been really interesting, and thank you for inviting me, Ruben.
No, thanks to you, because your presentation has been very, very interesting, very insightful, and also a learning experience for me. If we don't have more questions, I would like to thank you again, Mark, for your time, for your presentation, for sharing your knowledge. It is a pleasure to collaborate with you always, and just wish you a good period for relax in the coming weeks, and hope to meet you next year in really interesting activities. To the audience as well, thank you very much for joining this last webinar of the Invest Horizon project. Thanks for your interest, for your questions, and for being with us during this long period of working together. Thanks as well to my colleagues Livia and Joao that have been supporting the organization of these activities. And it will be a pleasure to meet you all, the audience, the speaker, and the colleagues in future activities implemented by EVN. Have a nice day.